Good morning to all of you. Brian, good morning.
Morning.
Christine, good morning.
Good morning.
At the end of the day, you must be willing to invest towards your customer on the goods that you're buying on credit. Okay. If, for example, you make a sale of good worth, let's say, a million, okay, and the repayment period is 1 month, okay, that the customer buys in the month of October, pays in the month of November. Now, what does that imply? It implies, therefore, that you're going to be extending, you're going to be giving your customer money, okay, of course, in terms of goods, okay, for a period of 1 month, okay. Don't forget, the customer is not going to be paying you the capital you have given to them, or rather, the working capital, the investment made in them plus interest. They don't do that, okay? So in case you make a sale of good worth 10 million, you get 10 million, okay, at the end of the 1 month credit period, okay? So it is an investment the company is making towards their customer, okay? So the question is, what are the factors that do influence the extent to which we as a company, we're going to be investing in our customer, in the raw material, in the payables, okay? In cash, okay? So what factors influence the amounts we are going to be investing at the end of the day, okay? One of them, of course, is the nature of the business, okay? And I guess we did the example of a retailer, okay? A retailer and a manufacturer, okay? In case you're a retailer, and I guess we say the case of a supermarket, okay? Give this example, the case of a supermarket, at the end of this market, they need to be making sales on cash, okay, which implies, therefore, the extent to which the company is investing towards the customer is very minimal in terms of the receivable, because they don't sell credit, okay? They make sales on cash basis. Therefore, the investment the company is making, for example, towards the receivable is quite minimal, okay, if any, okay? Then also at the same time, if the company is going to have, for example, you have involved manufacturing, okay? Most of the time, okay, you're going to be in quotes be pushing your inventory towards a retailer, okay. If you do make, let's say, Omo, okay, you're Unilever, you make Omo. Don't forget, you're going to manufacture the Omo, okay, but customer will not come to your premises, okay. You are the one, for example, who goes take this Omo to the retailers, to the supermarkets, okay. The supermarket don't pay you immediately, okay. You have to wait, for example, maybe 90-day period, okay, depending on the agreement you have with your retailers, okay. So therefore, at the end of the day, okay, the extent to which you could be required to invest, therefore, is going to be dependent on the nature of the operation, the nature of the business you are in. If you're going to build manufacturing, of course, therefore, that means therefore you invest more towards the inventory, because you have raw material, work in progress, you have the finished goods, okay. At the same time, you're going to sell on credit, okay, to the retailers, okay. That implies therefore you have more investment towards the account receivable, okay. So therefore, the nature of the business that you are involved in, therefore, will have an impact of the amount you'll be investing. A retailer, more or less investment, okay? If you're more towards service-oriented company, then of course, even the net working capital is quite low. If you're going to be involved in manufacturing, I think you get the case of Safaricom and Baboon, for example, okay? They're going to have a case where you do have a positive in case you're a manufacturer. In case you are a service-oriented company, Safaricom be the example, you even have a negative working capital, okay? So it depends what is the nature of operation you're involved in. Are you more towards the service? Are you more towards the manufacturing setup? Okay. Of course, you have the answer related towards the supplier's delivery. If you're not so sure, for example, on when the supplier will deliver the material, so what do? Or in case maybe the past, okay, suppliers have not been so forthcoming when it comes to the time of delivery, okay. The agreement they are meant to deliver within a day of you making the order, okay. However, the reality is that they do deliver maybe 2 weeks later, okay. Now the question is, if that's the case where you have suppliers who always delay, okay, what do? You may be in court be required to overstock, okay, because you never know, okay. Because if, for example, the delivery time, they promise that they meant to deliver within a day, okay, and they take 2 weeks. The question is that within those 2 weeks, you don't have inventory, you don't have inventory to make sales, you don't have stock in court, okay. Now what shall you be doing? So therefore, if this is a pattern that maybe you have been having with the suppliers, so what shall you do? You're going to be in quote be overstocking just in case the suppliers do make delays. Okay, therefore an excessive investment you do make towards the inventory. Okay, because of the suppliers delay, for example. Okay, then you have the policy of the company. Okay, so what is your policy regarding how you make sales? Okay, Because in case maybe as a company, you can have a policy is that to make sales on cash only. Okay, that implies therefore your investment towards the receivable is very low, and of course by implication, the investment towards the working capital is low. Okay, so what is your policy? Okay, if your policy is that you do make sales on credit, of course after customer achieving some certain minimum conditions, then more or it means therefore you will have investment towards the receivable. Okay, so the idea here is that at the end of the day, the policy you're going to be adopting in relation to the sales, will determine therefore the amount to be investing towards the account receivable and the amount to be investing towards the working capital. Okay, because in case you sell on credit, that means therefore more investment towards your customer, towards the account receivable. Okay, if you sell on cash, if that's your policy as a company, then that means for fewer investment you'll be making towards the working capital in terms of the account receivable. The next thing, of course, is the activity level of the business. Okay, of course, in case you are a retailer, you are then quote the normal kiosk. Okay, of course, your working capital investment is quite low. Okay, we can't compare the case of, let's say, Task is the case of Nakumatt and their peak. We can't compare. Okay, for sure, because these are business that have been in operation. These are business that their let's say the turnover is very high. Okay, but in play therefore the investment towards working capital will have to be high at the same time. Okay. So in case you're a retailer, of course, that means therefore you'll be having you're a small retailer, that means therefore your working capital investment is quite low. Okay. Also, in case again be in case of a large retailer, for example, of course your investment towards account receivable is going towards the working capital is also going to be high. Okay, because based on the level of activity again involved. At the same time, you can look at this from this angle that hey, at the end of the day, in case you do have higher level activities, then you as a company, you can be able to negotiate for better terms, for example, with the suppliers. You can go to negotiate better terms with them. That means, therefore, the amount to be invested towards the account is suitable. Towards the inventory, for example. For example, in case you are a big retailer, supermarket, you in quotes you can be able to bulldoze your terms to the suppliers. Tell them, hey, I can only buy from you in case you're going to give me credit. Or rather, I'll pay you after making the sale, because that's what's happened for most of these big retailers, they tell you that the only time I'll make payment to you is upon me making the sale. That means, therefore, they are not investing anything. That's what it means, They have not invested anything towards the inventory because they pay you upon them making the sale, So in case your commodity takes, for example, 3 months, then they'll pay you after they make the sale at the end of that month, That's the kind of what we call overall activity of the business. So the bigger the company is, in quote, there are the chance that they can be able to obtain, in quote, better terms with their different stakeholders, compared to a small entity, a small enterprise, Then, of course, the next thing is the level of operating cycle, This more or less applies more towards the company involved in manufacturing, How long do you take as a company? By the time you're going to start production and the time you're going to have, for example, having the finished commodity, How long does it take, for example, for the inventory, From all the time you start production to the time you'll be invest, to the time you're going to, for example, make a sale of that commodity. What's the length of time, If you make, I don't know, let's, for example, so that you do make a piece of bread, You are, I don't know which company, you are Broadways, for example, Your operating cycle is very minimal. It's only going to take maybe some few minutes, To the time you start production, the time you have the finished commodity, it's going to take some few minutes, Or maybe in case you want to consider the time of delivery, it's going to take some few hours, From the time you manufacture, the time that you have the end products, If we are to make another comparison, you see that you are Boeing, for example, you are Airbus, How long does it take for you to complete a unit? It will take months, sometimes even years, So definitely, therefore, you as maybe Boeing, you're going to, for example, be having a longer operating cycle. That means if you're investing more, don't forget within this cycle, you're still paying your employees, to manufacture, let's say Airbus, You're still, you're still buying spare parts along the way, Parts so that you can be able to have a finished commodity, The longer you take, the more you are investing towards your working capital, If you're going to manufacture at 7 in the morning and by 8 you've made a sale, then it means that your investment was only for 1 hour. It was only for 1 hour. So therefore, at the end of this, what is your cycle? Is your cycle longer or shorter? Because the longer it is, the more investment the longer you'll be investing towards therefore the working capital. Okay, the shorter it is, then we have a shorter period of investment. Okay, which is there, for example, going to be 1 hour. Okay, if you're going to be buying, you'll be taking months. Okay, your investment, you're tying down your capital on that inventory for a longer period of time. Okay. Of course, you have suppliers credit policy. Okay, also you deal with suppliers. Okay, I think I've just mentioned the case of retailers. Okay, the one of some of these biggest retailers. Okay, don't forget, for most retailers, the big ones. Okay, maybe Carrefour. You have I don't know, maybe Tascase. I don't know how it is now. And Naivas, for example. Okay, that's their general policy that, hey, we are going to pay you. Okay, as far as I know, that's what normally do. Okay, they're going to be paying you as our supplier. You supply us with, I don't know, you as Brookside, you supply us with milk. Okay, we don't pay you on the spot. Okay, we are going to pay you after you make the sale. So in case you don't make the sale, then too bad. You're not going to pay you. Okay, in case, for example, one of your commodities goes bad, then that is your cost as our supplier. Okay, that's so not happen most of these big traders. Okay, so either way, don't forget what's the policy you have with your creditors or with your suppliers. Okay, because in case suppliers, they are in quote, they are stronger than you, then of course they'll be demanding you pay before they deliver. Okay, but in case now you are the stronger one, okay, in terms of that position, then of course that implies that for you can dictate terms to your suppliers. Okay, and that might mean, okay, you having a lesser period of investment, okay, or less investment you do make towards working capital. If it is possible for you to negotiate better terms, okay, with your suppliers. Okay, those are some of the factors. Of course, there are many, but those are some of the factors that do influence the amount which their working capital investment required. Okay, those are some of the factors. Okay, are they all clear? Question. This is a question that the examiner has asked in the past. Okay, shall go through question back. Okay, and the examiner is asking you. Okay, discuss the factor that do influence the amount you be investing towards the receivable, for example, towards inventory, towards working capital itself. Okay, so this can be a question that can be asked in the exam. It has been asked in the exam. Okay, we shall go through some of the questions that the examiner has asked in the past. Okay, it's good in case there's no question. Maybe it means you did understand the concepts. Now, going back to where we were discussing on some of the way we can use to evaluate, okay, how efficient, okay, the management is in terms of managing working capital, okay. And we did discuss and did some questions with regard to the cash conversion cycle, okay. And we did say that the cash conversion cycle is the length of time it takes from the time that you pay, from the time you pay your supplier, the time you receive money from your customer. Okay, that length of time is referred to as the cash conversion cycle. Okay, and as we said, it is not a must to be a positive or negative. Okay, it can go either way. Okay, so like I think we saw from one question where examiner was asking you, should it be a positive or should it be a negative? Forget, it can go either way. Okay, it does not mean it's a positive that's something good or bad. It does not mean it's a negative, it's something good or bad. It can go either way. Okay. So that was the first assessment we did use, okay, when it comes to evaluation of the extent of management efficiency in managing working capital, okay. Now, there's another ratio you can use, okay. One of them is called the current ratio, okay. They're referred to as liquid ratios, okay, called the current ratio. Now, the current ratio, we are trying to evaluate, okay, to what extent, okay, what's the extent of the company liquidity in terms of being able to pay off the current obligations from the current investments, okay? How many times, for example, can we be able to pay off our obligations, okay, as current liabilities, okay, from what we currently own in terms of the current assets, okay? If, for example, you have an issue, and the ratio is given us, of course, current assets divided by current liabilities. If, for example, we have a ratio of, let's say, 1.2, okay, what does that mean? It means, therefore, let me just use 2, okay, so that we get the ratio equal to 2, okay. Now, what does that mean? It means, therefore, that if we were to pay off our current obligations, then we can be able to pay them off 2 times from the current assets, okay. That's what 2 means, okay. But we can be able to pay off our current obligations, current liabilities, 2 times from what we currently own, from the current assets investment. If the ratio increases from 2 to, let's say, 4, okay, Now, what does that mean? It means therefore that we can be able to pay off our current obligation, okay, 4 times from our current assets. So an increase in the ratio indicate an increased company liquidity, okay. An increased company ratio indicates therefore an increased company liquidity. A decrease, of course, defines that hey, the company liquidity is decreasing, okay. Because therefore a decrease in the liquidity, okay. So at the end of the day, okay, what's the best ratio to have? Okay, this is upon debate. Okay, it's not a must to be one. Okay, it's not a must to be one or two or four. Okay, it depends definitely in the nature of the business that you are in. Okay, that's one key factor. Okay, Safaricom, you have been having a negative. Okay, you as Bamburi, you would be having a positive. Okay, so don't forget it depends what industry you will be in. Okay. Anyway, so let's apply the current ratio, okay? But a decrease of the ratio indicates a decrease in liquidity, okay? An increase indicates therefore an increased company liquidity. Don't forget what you mentioned regarding the profit you're making, okay? So in case you do have, I'll assume that the industry, okay? Don't forget we compare the ratio of the company versus the industry. If the industry has a ratio, let's say 10 times, okay? And you have a ratio of, let's say 4 times, okay? A ratio of 4 times, that means therefore you can deem you to be a bit liquid. Because if you compare with the company, okay, it can't deem that you're a bit liquid, but it means you have lower liquidity than what the market is in quote wanting, okay? Because other firms in the same industry, okay, have a ratio of 10 times. You have a ratio of 4 times. It means for your ratio is lower than the market. It means for you are more or less you have a lower level of liquidity compared to the case of the industry. Okay. But in case maybe the industry has a ratio of let's say 2 times, okay, then you can say that you have more liquidity. You have, let's say in quote, an excessive liquidity, okay. But the industry is 2 times, but you have 4 times, okay. So they have more liquidity than even what, for example, the market is dictating, okay. Don't forget what you're assuming here is the market is like the optimal, okay. That's the assumption you're making here. But like the ratio of the market ratio, market averages is like the optimum. So in case you're not at the market average, you're at 4 times, then it means you have more liquidity than what is required of 2 times. Clear? So here, this is not a rule of thumb, okay? It's not a must, okay? So it's not a must, but just put a figure to it, okay? So it's not a must to be a 2, okay? It can be either be it depends, okay? So take this with a huge pinch of salt. That's on the current ratio, okay? Question on the current ratio? Okay, then we do use another ratio to assess on the company liquidity that is a bit more conservative. Okay, what referred to as the use of the quick ratio. Okay, the use of quick ratio. Now, the quick ratio, okay, what does it evaluate? Okay, it's simply going to evaluate or assess the company liquidity by using the liquid part, okay, by using in quote the liquid part of the current asset, okay. So we're trying to avoid, okay, all the illiquid parts, okay, when we are going to be evaluating the company extent of liquidity. Okay? So, for instance, okay, we notice that inventory is one of the illiquid part of the current assets. Okay, why is it illiquid? Okay, because by the time you're going to be able to convert, okay, the inventory into cash, okay, let's even begin. As if you're going to be involved in manufacturing, it will start all the way from raw material. Okay, you start from raw material. Okay, for example, you begin for raw material, convert to work in progress, convert to finished goods, then make a sale on credit, okay, credit sale, then receive cash, okay. So the process will take you a month. It might, okay, maybe it might take months. Therefore, you cannot in quote rely on the inventory as part of liquid assets as your part of your liquid assets. Okay, why? Because it takes much longer for you to be able to convert the inventory or the raw material, for example, into cash. Okay, therefore it can be deemed to be illiquid. Okay, so in case now we remove the inventory, okay, from our current assets, okay, we remain like in quote only with the liquid part of the current assets. Okay, that is cash and the receivables. Okay, cash and the receivables. Okay. Now, therefore, if we want to evaluate, okay, to what extent can the liquid part of the current asset be able to pay off the company current liabilities? If we get, for example, a ratio of 1, what does it indicate? A ratio of 1 indicates that we can be able to pay off our current obligations, our current liabilities, okay, to 1 time from our liquid part of the current assets, that is from cash and plus receivables. Okay, that's what the ratio 1 means. If the ratio is increasing, of course, indicate an increase in company liquidity. If the ratio is decreasing, then it indicates a decrease in the company liquidity. But of course, to do a good interpretation, you compare with the industry averages. Okay, so compare with the industry averages. Okay, what's the quick ratio for the industry? Okay, if the industry has a ratio of, let's say, 2 times, okay, and you have a ratio of 1 time, what does it mean? It means that you are a bit liquid, okay, in that sense, okay, because you are optimal in quotes, your industry average ought to be at 2 times, but you are at 1 time. Clear? Question? Daisy, any question?
No, sir, I'm fine.
It's clear.
Yeah.
Okay, great. Elvin, question?
No, sir.
Okay. So that's on the use of the different measures of liquidity. There's another issue which the examiner does consider, which you can also use. Okay, maybe let me just mention it. It's called the cash ratio. Okay, but your examiner doesn't consider it. Okay, but just for your knowledge. Okay, because I've never seen it being asked. Let me just. It's called the use of the cash ratio. Okay, it's called the cash ratio. Okay. Okay. Now the cash ratio. Okay. Cash. Give me some time. I'm sure what's happening here. Hmm. I'm not sure what's happening with my pen here. Just give me a second. I try to sort it out. Okay, cash ratio. Now the cash ratio, okay, it's an even more conservative measure of the company liquidity. Okay, that we are only going, or we want to make an evaluation of the company liquidity based only on the company cash position. Okay, it's an evaluation of the company liquidity based on the company cash position. In short, if we were to pay off the company current obligations, current liability from our cash only, how many times can therefore our cash be able to pay off our current obligations? Okay, therefore the cash ratio is given there for us. Cash we divide therefore by the current liabilities. Okay, we divide by current liabilities. How many times can the company cash position be able to pay off the company current liabilities? Okay, that's referred to as the current ratio. Okay, so it's a more conservative, okay, measure of the company liquidity because we want to make an evaluation. If the all our suppliers, okay, all our current obligations, okay, were to be required to be paid today, okay, and if we were to pay them using our cash only, okay, how many times can we be able to pay them off using our current assets only, using our cash only? Okay, how many times can we be able to pay them off? Okay, that's referred to as the current use of the cash ratio. Okay, clear. But as I mentioned, don't forget this. I've not seen an examiner asking you to do cash ratio. But it's good way. You never know. Okay, so it's just good enough to get to know of it. Clear. Sakina, it's clear.
Yes.
Okay, great. Okay, now let's do an example. Let's go through our question bank. Okay. Okay. Okay, some of the questions that your examiner asked from this area. Okay. I'm not sure whether we did discuss this question. I think it looks familiar. I think we did discuss this. This is page 4, page 5. Okay, page 4, page 5. Pick a company. A. Have we done A? I think we've done A. Identify the objectives of working capital management and discuss the conflict that may arise between them. I think we discussed this. Sanya, did you discuss this?
So I'm just opening the page 1 minute.
Okay. Brian, does this look familiar?
I'm not sure. I feel like we did a PK something, but I'm not sure it was this one.
Okay. And I think this question, I think don't forget, as mentioned, there are two objectives. Okay, we have liquidity and you have profitability. I think it looks familiar. I think again I can't remember, but don't forget there are two objectives you want to achieve when it comes to working capital management. Okay, you want to achieve liquidity objective. Okay, and of course, you have to be able to make profit, profitability objective. Okay. Of course, you discuss each one of them. What does it mean? Liquidity is that the company can be able to pay for its current obligations as and when they fall due. Okay. Profitability, the company will need to have or need to make positive returns on its investment they do make in working capital. Conflict is that if you need to have a case where the company has excessive liquidity, that means if they are more towards investment towards cash and of course plus cash equivalents, what does it mean? You make very minimal returns. Okay, you make very minimal returns. Don't forget, the long-term assets, the long-term or the non-current assets are the ones that are able to generate profit of the company. Okay, so in case you have less investment towards the non-current assets, which are liquid, okay, of course that implies that you make very minimal profit. But in case you do pursue more profit, that means you invest more towards the non-current asset, which are illiquid on their hand. Okay, so the two objectives will be at conflict. So the company management, what do? It's you to ensure that you strike a balance between these two objectives. Okay. Anyway, it's clear. Okay. The other part we can discuss for now.
Sir, could you please repeat that again?
Okay. We see the two objectives that you want to pursue when it comes to working capital objective, liquidity and profit making. Okay. Towards liquidity, what's liquidity? Okay, is an assessment of the extent to which the company can be able to pay for their obligations as and when they fall due. Profitability is about making positive returns. It's about making positive returns from the company investment, also the company working capital investment. Why do they conflict? We mentioned that in case of the company, you do intend to make profit, then it means that you have to invest in assets that make profit. And the assets that make profit for the company are the non-current assets. They are the ones that are able to make more profit. However, since they are more liquid, that implies that for the company, liquidity objective will be hard. Yes, you make profit. However, don't forget you are a bit more illiquid because you have invested more towards the non-current assets. Okay, that's in case you're pursuing more of profit side. If you pursue more of liquid side, that implies therefore you're going to have liquid assets. Okay, more towards cash and cash equivalents. Okay, at the end of the day, don't forget these assets bring very minimal returns, if any. Okay, an example: if at the beginning of the day you have 1,000, okay, dollar, okay, 1,000 shares traded, at the end of the day it will remain 1,000 if you have not used it. But it is going to be lower than that. It's not going to bring any interest. Let's pull that up. Okay, so the more liquid you are of the company, the higher the chance that you're missing out on other opportunities to make profit by investing that money. Okay. So you can see this objective. as mentioned, they're going to be in conflict. It's upon you as a management to try to ensure you strike a balance. Okay, it doesn't mean that you do 50-50, no. Okay, but to ensure that you pay attention to these two objectives. Every work in capital decision that you make ought to pay attention to these two objectives. Okay. Okay. Yeah, like this question, we have just discussed this. This is page 6, FLG company. Okay, page 6, FLG company. Part A is asking us, discuss the key factors which determine the level of investment in current assets. I think you've just mentioned here. We have discussed the factors, okay, that determine how much you're going to invest towards assets, okay. Let's just have a quick recap. Was it just got it? Nafisa, first factor.
The factors affecting the level of working capital.
The
The nature of the business.
nature of the business, that's a factor that we did mention. Okay, we have just mentioned actually. Okay, the nature of the business you are in. Okay, I will give you an example of service or manufacturing setup. Okay, service company, of course, you have lower investment. Okay, why? Because you don't need to invest towards raw material, towards work in progress, towards finished good. You don't do that. Okay, but in case you're a manufacturer, you do require to invest in all these components. Okay, what else, Daisy? Daisy.
Yes, sir.
The factor.
Factors of.
What's the question on the screen? Page 6, question 3.
I can't see it clearly.
Do you have a question bank?
No, I don't. My email, I got my password, but then my e-learning is still having problem. I was told to go to school today.
Hey, okay. Brian, yeah. Could you say the question bank on the WhatsApp group? Maybe it's for the sake of those people who don't have it. Brian can do that.
Okay, I'll do that after the class. I don't have
Okay.
my phone.
Okay. Sure. Okay. So the question Daisy here is, discuss key factors which determine the level of investment in current assets, which of course by implication is working capital. That's the question. So Nafisa told us the first factor, which we did discuss together, okay, which was on the nature of the business operation that you are in. What are the factors, Daisy?
Sorry. I'm just checking my notes. A minute. Can I write the question as you tell me and then give me a minute to answer? Factors?
Okay. Factors to determine the level of investment in current assets.
Determine the level.
Let me just check with the rest. Can you see my screen?
Yeah, it's not clear on my side.
It's not clear. Okay, let me check from someone else. Elvin, how is the screen from your, my screen from your end?
No, it's clear.
It's clear now.
Yeah, now it's clear.
Okay. Okay, as Daisy composes, I'll get another point from Sakina.
Yes.
Yes. What are the factors?
Length of operating.
Yes.
Length of operating cycle.
Yes, the length of operating cycle. Okay, I think we discussed that. The length of operating cycle. Okay, how long does it take until the time you start, for example, manufacturing, the time that you end up having the finished commodity? What's that cycle? What's the length? Okay, if this investment take longer, okay, it will take long to convert the raw material into finished commodity. Boeing gave example of maybe Broadways. In the case of Boeing, okay, the two of you have very different investment to make towards the current assets. Okay, definitely. Okay. Anita, what's the other factor? Anita?
Sir,
Yes, DC.
the cash operates in cycle.
The cash operating cycle, stroke operating cycle. Yes, it is a factor for sure. Okay, which I think yes, it is a factor. Which I think someone has mentioned it. Anyway, I agree. Sakina has mentioned it. I think. Okay. Anyway, yeah, it's a factor.
Can we say Can we say the inventory turnover period?
Yes, inventory turnover period, which more or less is going to be the same as operating cycle. Yes, it is the same, unless you want to explain more to the same point.
Okay, fine.
Okay. Sanya.
The supplier's credit policy.
So in this example, maybe supply credit policy. Okay, it can maybe it can, but I would want to avoid it because here it's more towards the current asset only. And I hope you see that point because supply credit policy, okay, is going to be affecting the payables, and payables might not be part of the current assets, isn't it?
Okay, so the company's credit policy.
Yes, that can affect, of course. Okay, what's your policy? What is your policy regarding your customer? Okay, because that we mentioned that is going to be affecting the amount to be investing towards the account receivable. Okay, that one is for sure. What is your policy you have with your customers? Yes, it is going to affect therefore the amount you invest in or towards your account receivable. Okay, the other fact will be your competitor. Okay, what's the competition? Okay, so of course therefore this will look here. Yeah, that could be maybe the competition. Okay, the competitors terms. Okay, what are your terms to your competitors? Okay, competition terms. Okay, because definitely don't forget. For example, you're fighting for the same customer. Okay, if maybe the industry or the competition, okay, they don't offer credit to your customer, then most of the time you'll be doing the same. Okay, as a company, if your competition offers, let's say, discounts to your customer, you'll be forced in court to pay to be offering your customer discounts. Okay, so because you may want to be like sort of you don't want to lose customer because if your competitors do give credit, then you do the same most of the time. You're going for the same thing because you don't want to lose customers. Okay, so therefore that's another factor that can affect therefore the amount you invest, for example, towards account receivable. Okay, what's the competition? Okay, do they give discounts or not? Okay. We are going to discuss this because these are 6 marks. At least discuss 3 points. Okay, 6 marks. At least discuss 3 points. Okay, the minimum that is. We can do part B, but I think we can do part C. Okay, so go through the question. We do part C together. Okay, let's use the question together. So you need to calculate the size of overdraft for this company, net working capital, and total cost of financing its current assets. Okay. So in this question, okay, we may need, or rather, we have been given the current ratio, okay, the cost of financing, the long-term, the financing, long-term finance, okay, at 11%. Okay, so let me just get a snip of this question. Okay, this still misbehaving. Yes. Okay, so current ratio we given is equal to 1.4. We've been given the sales minimum credit, the cost of sale, and the current asset consists of inventory and the receivable. So I guess from there, I think we can get the two. We get the receivable and we get the inventory. Okay. Company gives 2-month credit to customer. Okay, 2 months for customers, and on average, 1 month credit for suppliers is given. However, the company has a cycle of 3 months. Okay, I think we should begin there. The cycle, don't forget, is made of days for receivables days. Okay, these are days. Which we told is equal to 2 months. Okay, plus the days for inventory, which you're not even given. Okay, it's missing. Okay, it's a miss. That's a miss. However, we have days for payable. Okay, which is equal to payables days is equal to how many days? 1 month. To give therefore cycle equal to 3 months. So how many days do you have for inventory? Inventory days.
Two.
Yes, you get 2. So you get 2, therefore, to be the inventory days. Okay. Those 2 plus 2 minus 1 to give us 3. Okay. We get for inventory days, we go to 2. Thank you, Simon. Okay. Now, have we known the days for inventory, the days for receivable? I guess now we can tell, therefore, what was the implied investment towards inventory, the implied investment towards the receivable. Okay. You've been given that. So we can begin here. The investment towards the receivable investment will be equal to the days, which is 2 months, 2 out of 12, times the sales made on credit, in this case equal to 4.2 million. The inventory investment, okay, the amount the company is investing towards the inventory, the same thing, will be 2 months out of 12 times the cost of sale, which is equal to 1.89 million. You get how much to be the inventory investment, therefore? 700,000. Confirm. Was the receivable? Was the inventory?
Inventory is 300,000.
Okay, 3,000. What of receivable? It's 700.
Yeah, it is. It is 700,000.
Okay, great. Okay.
Inventory is 315.
Yeah, the inventory seems to be. Should we have 3 what? No, this is
350.
315.
Yes.
Okay, this is 8.9 million. So we get 315,000.
Sorry, I didn't expect it.
Okay, don't worry. Okay, so here therefore the total the current assets is made of those two. Therefore, to give a therefore 10, 15, okay, thousand to be the total current assets. Okay, great. So we have done for the numerator. The current ratio, which is given us the current liability, is given as current assets. We divide by current liabilities. So we have the numerator here. So the denominator is made of 2. Okay, as for the question. As per the question, we've been told the liability consists of payables and overdraft. So I guess the next thing we can do is to get the payable, okay? Payable investment. And payable, the amount the supplier has invested in us is equal to 1 month out of 12 times the cost of sale, 1.89 million. Give us 157,500. I don't know, I'm just trying to guess. What's the payable?
157,500.
Okay, great. We get 7,500 for the payable. Okay. And you can do next is that we have the current assets, we have current liability. Now, in the case of current liability, we have two components. So now we only have one component. So we need to get the second component, which in this case is the overdraft. Okay. However, you've been given the current ratio. Current ratio, it given is equal to current assets of the company. We divide by current liabilities. So divide by current liabilities. Okay, this is therefore will be equal to current assets, which you've seen is equal to 1015. We divide by current liabilities is equal to 1.4 times. Is equal to 1.4 times, I guess. Yes, 1.4 times. Therefore, current liabilities is equal to how much? Therefore, current liabilities is equal to 1015,000 divided by 1.4, and you get how much?
725,000.
725,000 for the current liabilities. Okay, thank you. Now, if you remember, I said that current liability is made of two components: overdraft and the payable. Okay, we know the total, which is 725,000. We know the payable, so the balance must be the overdraft. Therefore, overdraft will be equal to 725,000 minus payable, which we got 157,500 from our previous workings. Okay, and therefore, what's the overdraft? 5.
567,500.
5 therefore the company, the amount the company has borrowed, okay, in terms of from overdraft financing. Okay, therefore that's our first answer to that part B. You're meant to get overdraft, you also meant to get net working capital. So the next thing is to get net working capital. Net working capital is given as current assets. Okay, so it's capital is equal to current assets minus current liability minus current liabilities. This therefore be equal to current asset, we got 1015,000. Current liability, have it here, 725,000. Give us how much? 290. I don't know if it's 290, confirm.
It's 290.
Okay, we'll get there for the net working capital to be 290. Current assets minus current liabilities. So that's the second part to the question. That part of the question, we're meant to get the financing cost. Okay. So first is for us to determine what is the total amount of capital we require to invest towards our current assets is equal to the current assets. That's the capital that we require. Okay. The current assets is the capital that we require. Now you've been told that this is going to be financed. First, we have overdraft. Okay. So financing cost. So first the company has borrowed money, okay, from the bank through overdraft. Okay, so therefore, find interest on overdraft. Can begin there. Interest on overdraft. The amount the company has borrowed through overdraft is 567,500. Okay, so 567,500 at a cost of overdraft financing. The cost is equal to 7% per year. So multiply by 7% per year. Okay, so you get how much with the interest you pay on overdraft?
$39,725.
$25. Okay, that's the interest you pay on overdraft. Don't forget. Okay, we also need to get money. Okay, let me actually, I think I did start this part on the wrong side, but anyway, let me just draw a tree diagram. First, our need is 10, 15,000, or rather 10, 15,000. So first, the first person to finance us is overdraft. Okay, which is 500, and of course the 7%. Then we also have payables. So for the suppliers also finance, they give us money. And the payable, they're financing us how much? We got, it was 157,500, 157, 500, 157, 500. But don't forget, they don't charge anything. This payable, the supplier don't charge you anything. So zero cost there, okay? The balance, who is financing the balance? Because here, the total must be 10, 15, 500. But this total are not given, these two totals are not given as 10, 15, 500. Now, who is financing the difference? Because the need for capital, which is total current asset investment, is 10, 15. Overdraft are given 57. Payables, 157. Who's financing the difference now? Actually, what's the difference? Let me begin there. What's the difference? What's the difference?
290.
290,000. Difference 20,000. Okay. Now the question is, who is giving us this 290? That's the question. Sanya, who is financing us 290?
So, that difference is between 567,500 and 157,500.
No. The difference here. First, let me repeat. The total amount of money you need is 10, 15. Okay, isn't it? Because
Yeah.
finance, isn't it?
Mm-hmm.
Out of 10, 15, someone overdraft have given you 5, 7. Clear? Payables
Okay.
have given you 157. Clear?
Yeah.
But these two finance sources are not yet enough to cover for the 10, 15 that you need, isn't it?
Oh, okay.
So what's the difference? Because what's the difference now? We get 290,000.
Yeah.
10, 15 minus 57 minus 157, and we get 290,000. It's clear?
Yeah.
Okay. So the question is, now who is giving us this 290?
Maybe like a bank.
Okay, a bank. Okay. It's given there in the question, by the way. It's there in the question. But not so direct, that is. It's there in the question. Can you see long-term finance? Can you see my long-term finance in that question? Elvin, can you see somewhere long-term finance?
Yeah.
Yes, it's there. It's long-term finance. Don't forget, this is going to come from long-term finance. It's not from a short-term finance. Okay, it's going from long-term finance. So these are the one financing you. And what cost? 11%. 11%. Okay, you can see all that. Okay, 11%. So therefore, the cost here is 0. The cost here, we have done that, and you go that 9. I can't remember that's 9 what? Done that already. That's 9, 725. 725. Then here, don't forget, what was the cost here? 290,000 came from the overdraft, came from long-term finance at 11% per year. So how much interest did you pay to the bank, whatever it is? You're paying how much? 30? That's 900? I don't know. Oh, that's one.
31.
2,900. Okay. Okay. The amount of interest you paid to the long-term finance provider, the 2,900 total. 71. Confirm. 71,625.
Yes. Yes.
Okay, therefore, the total interest you're paying is equal to therefore $71,625. That's total financing cost. Clear? Any question? Sakina? Nafisa, any question?
No, sir.
Okay, great. That's what you meant to have done. That was your question. Okay. On how to. Yes, someone has a question. Yes.
Yeah, I have a question.
Mm.
Just can you explain to me for the receivables days and the inventory days, how do you do the calculation for that?
The days for inventory.
Yeah, like, okay, so where we have to get the figure of receivables and the figure of inventory, right?
Oh,
Because
okay.
we've been given the days.
Okay, so don't forget the formula I gave you. Okay, it was days for the receivable. For example, the days for the receivable. Okay, we said it's given us the receivables days. It's given us 365 or let's use month here. Okay, let's use months. It'll be 12 months times the sale made on times the receivable investment. We divide by sales made on credit sales. Now we have the here, in this example given here, we have the days, we have the sale made on credit, we don't have the receivable. So what do? You make therefore the receivable the subject of the formula here, which will be equal therefore. Will be equal therefore. Yes.
Yeah, okay, I get that. I'm wanting to confirm that even if we use like 365 days, would we get the same answer?
Okay, I would
Or is
propose.
it just better to use
Since the days are given in a week, in months, use months. Okay. If the days are given in weeks, we use weeks.
Okay.
To avoid that process of converting from
Okay.
months to days, from days. Yeah, so just follow what is given to the examiner. If the examiner give you months, use months. If the examiner gives you weeks, in a year, how many weeks do you have? Sanya?
52.
52.
52. So don't convert them. Just use the way they are given by the examiner. Okay? Don't convert them.
Okay.
Yeah, so
Okay, thank you.
that's that small error of converting, but just use the as they've been given to you. It's clear. Okay.
Yes, sir. Thank you.
Okay. So that's that question. Okay. I think it was a straightforward. Okay, but not so straightforward. I don't know, but I think it's not a tricky question, but not an easy question. Okay, I think it's in between there. Okay. So question on that question. Before I look for another question. Okay. Saying that all of you understood well. So let me give you one. More or less applying the same concepts. And see how far you can go. Sanya.
Yes, sir.
What was the change in the cycle?
So I'm still trying to figure it out.
Oh, okay. Sakina?
I'm still doing it, sir.
Okay. Daisy?
I'm also working on it, sir.
Okay. Actually, I thought that you guys will be finished by now. Anyway, let's do it together. So you confirm what you've been doing. So let me get the question. Okay, so we told that for the change in working capital policy, calculate the change in the operating cycle. So we need to determine what's the current cycle versus what will be the cycle after. Okay, so current cycle, so we have inventory, we have receivable, we have payable. From that, therefore, we can get a cycle. So first, we need to start off by getting the days for receivable. Okay, days for receivable, receivables days. 360, there is 5, yeah, there is 5. We multiply by the receivable investment, which in this case is equal to 1331.5, okay, 500. We divide by the sales minimum credit. Let me just go back to the question. The sales is 5.4, okay, because sale 2.16. Okay, 5.4 to 2.16. So 2.4 sales is equal to therefore to 5.4. How many days for receivable? For receivable?
90 days.
90 days, okay, so these are days, so 90 days, okay. Then the days for inventory, the same process. Inventory days will be equal to 365. We multiply by the amount the capital is invested towards inventory, which is equal to inventory investment is equal to 50. No, sorry, is equal to 473.4. Okay, 400, that is, divided by cost of sales, okay, which is equal to 2160. To give us how many days for inventory?
80 days.
80 days, okay. We less the days for payable. The days for payable. Payables days will be equal to 365 times payable, and the payable will be told is equal to 177,500. We divide by cost of sale, which remain at 2.16 million. Because how many days for payable?
30 days.
40.
30.
30 days, okay. Therefore, 90 plus 80 minus 30 to give us 140.
Yes.
40 days, okay, to give us therefore 140 days, okay. If we go as per the proposal, okay, we told that if we bring the proposal, the days for inventory will be, the days for receivable will be 62. If this is the proposal, will be 62 days. The days for inventory will be 50 days. The day for payable will be equal to 45 days, so minus 45. Give us how many days?
67.
67 days, okay. Therefore, we remain to calculate the change, okay. The change, just calculate, okay. Comment on your findings, okay. So therefore, if the company was to implement the proposal, then the cash conversion cycle or the operating cycle will decrease from 140 days to 67 days. Okay, decrease from 140 to 7 days. That's simply because you're going to comment on it. Clear? That's the first part. Okay, to get the change in the operating cycle. That's the first part of the question. Okay. Now, the second part of the question, the effect on the current ratio. Effect on the current ratio. So currently, I guess we can go together current ratio. So the next working can be to get on the current ratio. So current ratio. I'll say again as current assets of the company divided by current liabilities. Okay, so current position, okay, that before the proposal, okay, is equal to the current ratio is made of two: inventory plus receivable minus the payable divided by the current liabilities, which is equal to 1804.900. That is, we divide by current liability, which is 1504.100. To give us 1 point. wait.
1.2.
1.2 times, okay? We get 1.2 times to be therefore the current ratio, okay? If we implement the proposal, we do need to get the, if we implement the proposal, we do need to get, what do we need to get? The inventory, the receivable, as well as the payable, okay? Okay, the plant working capital is not replaced, the policy will not change the current sales and credits, the cost of sales, or the net working capital. Okay, that's great. So we do need to get the proposal, we don't get the inventory. So the amount we invest towards the inventory will be equal to the days of inventory, as per the proposal, should be 50. Out of the total number of days in an year, that is 65, we multiply by the sales, by the cost of sales, and you'll be told that it will not change, isn't it? Yes, it will not change, which is made therefore at 2.16 million. Therefore, how much will the company be investing towards the inventory if they implement the proposal?
295,900.
295,900. That is the case the company implement the proposal. Okay, continue. If the company, okay, if the company implement the proposal, the receivable investment, the receivable investment will be equal to the number of days for receivable, which will be 2 days. Out of the 65, we multiply by the sales, and the sales is 5.4. I can't remember. Let's go back. 5.4, yes, 5.4 times therefore 5.4 million. Therefore, how much will the company be investing towards the receivable if they implement the proposal?
917,300.
917,300, therefore the company investing towards the receivable if they implement the proposal. The same applies for the case of payable. Payable investment, the amount the suppliers will be investing in the company will be equal to 45 days. Out of the 65, we multiply with the cost of sales, which is 2.16 million. To give us how much?
266,300.
300, okay. Now, current assets of the company is made of, we be told that the net working capital remain constant. So therefore, we can determine what was the net working capital before, okay? So net working capital, okay, is equal to current assets, which was equal to 1804.900 minus current liability, which was equal to 1504,100. Give us how much with the net working capital?
300.8.
328.
300.8.
No, 300.8. Okay, we do that. This is going to remain constant even after. Therefore, the net working capital after, okay, don't forget to be the same. 300, 800. We made of the current assets of the company, okay, and the current assets of the company after will be the inventory. We have it here plus the receivable. We have it here. So current assets is equal to 295,900 plus 917,300, okay, minus current liability, minus current liabilities. Therefore, what's current liability? Okay, simply the sum of this plus this minus 300, 800. Can you get?
912,400.
400, 912, 400 for the company current liabilities. Okay. Okay, 912, 400 for the company current liability. Now you have the current assets and you have the current liability. Can you get the current ratio now? Yes, you can get. Okay. Therefore, the current ratio after we implement the proposal, we got current assets. What are the sum by the? What are the sum of here? These two, the current asset company. 12?
12, 13,
1,213,200.
12, 13,
200.
200.
200. We divide by current liabilities, which I've just done here. 9, 12, 400. So 9, 12, 400. And you get 1.?
1.33.
1.33 times, okay? So you meant make the comment, okay? We have seen that the current ratio is increasing from 1.2, okay, to 1.33. What does it indicate? It indicates the company is becoming more liquid, okay, since the ratio is increasing. Okay, I think we made that comment that if the company was to implement this proposal, then its current ratio will be increasing, okay, its liquidity will be increasing as shown by the increase in the current ratio from 1.2 to 1.2 times to 1.33 times. You meant to comment, you write it down, okay? Clear? Okay, that's the next part of that question. And lastly, financing cost saving, okay? Financing costs. This is the process normally follow, okay? As I mentioned. So before the company, the need for capital, okay? Let me just call this is before, okay? The company invent total requirement of capital, okay, is 1804 900, okay. Part of it is financed by payable. Part of it was financed by payable. This is before, and the payable were financing 177 500. Okay, part of it was financed by overdraft. Okay, where the financing 13. Okay, this is 13, 1326, 600. Yes, 600. Okay, payable 0. Okay, overdraft you do finance at a cost of how much? What's the overdraft financing? You're going to assume the short-term borrowing rate of 5%. So you can't see to get in the case of interest cost here. Yes, 5%. Okay, so you be therefore be financing at 5%. Okay, now. Okay, so the overdraft as well as the short-term borrowing. Okay, is there any way we have a specific rate for overdraft? Because I seem not to get it to anywhere in the question. Okay, I can't go to get it. Let me just check.
The short-term dollar borrowing rate.
Yeah, I think that we have to assume that should be the assumption we shall be making. Okay. Yeah, that's how you could make that. Even the cost of the overdraft is at 5%. Okay, the assumption we shall make. Okay, so therefore we're going to assume even the other financing here. Okay, I'm trying to work how you can finance because here the need is how much? What's the total need here? Total financing from payables and from overdraft. I think it's 15 what? So let's say this the current liability. 15 something. 1504. 1504.1. Okay. However, don't forget the need is 1804. Okay, so you're going to be assuming therefore the other will come from other finance source. We just call other finance source, and the cost still remain at 5% because we don't have any other cost. Okay, because we've been told there's short-term borrowing rates at 5%. Okay, so if the company need of capital will therefore be the same thing. Can be financed using the 5%. Okay, clear. Therefore, the total amount of money to be financed through overdrafts, okay, and our case here we have assumed, okay, we'll call the other, okay, will be equal to 1804 minus payable, isn't it? The sum of these two, the overdraft plus the other finance source, okay, will be equal to 1804 minus 177 500, okay. It's clear.
I'm not getting.
Okay, so how much is for the others here? Okay, I'm just calling other finance source. Okay, what's the difference here?
300.8.
300, 800.
Yeah.
300, 800 at the same cost of 5%. Okay, at the same cost of 5%, which implies therefore the total amount of money that you're going to be receiving that has interest, okay, will be equal to the sum of these two. This is where there is interest, okay. Because for overdraft you pay 0%. However, and for payable you pay 0%. Overdraft we have assumed is the 5%, and the other finance cost, which we require in the 800, still remain at 5%, which is equal to 1804 minus 27, 500. The sum of these two is the same. Okay, is 1804 minus 127, 500. Brian, that's clear?
Yes.
Yeah. Okay, it's just like the sum of these plus these will equal to 1804 minus 127, 500. Okay. And that is it. Okay, so here we get the cost. Okay, you can either want to do it individually here or just do the sum. Okay, whatever you want to prefer, it'll be the same thing. Okay, anyway, so the interest here on the overdraft. Oh, actually, you don't need to. Okay, what you can do, anyway, just give me the figure. There was an easier way of doing it. Overdraft.
81,370.
81.
66,330.
Total or for the overdraft?
Okay, no problem. Okay, 66. You get what 6 what?
66,330.
330. Okay, for the other financing. 305%.
15,040.
15,040. Okay, some give us 80.
81,370.
81,370. Okay, that's therefore is the current cost. Okay, we are currently the cost we are currently incurring for financing working capital. Now, what if you implement the proposal? Okay, that's the next question. What if we implement the proposal? Okay, first, the need for capital is the total current assets of the company, which we have done it somewhere. Yeah, it's here. Okay, this is a company total current assets that we require. That's the company total amount they need to finance. Okay, which is 1213,200. So therefore, 1213,200. Is it 200 or 400? 200. Okay. How is it going to be financed? Out of it, we are going to finance through payable. And for the payable, we got what? Payables, we got financing from payable. This it's here 266,300, 266,300. The difference will be overdraft plus the other. Let me just call it other finance source. Other finance sources, which is how much?
$946,900.
946,900. Okay, don't forget both of them. Okay, the reason why I don't want to make the distinction here, they both have a cost of 5%. 5%. Okay, so you may want to do the like we have done here. Okay, here we have done overdraft, then another place for other financing source, but there's no any difference because they both charge are the same cost of 5%. Okay, so here 5%. Therefore, the interest cost after is equal to 5% times 946,900 to give us how much cost, therefore
47,345.
47,345.
Yes.
Okay, so this is the interest cost being carried after. Okay, compare the interest cost you used to pay before, 870. So you can see there's a saving of how much? The difference. Okay, therefore interest cost saving will be equal to 81,370 minus 47,345 to give us how much?
34,025.
0.25. Okay, therefore the company, if the company implements this proposal, then there will be an annual net interest cost saving of that 4,025. That 4,025. Clear?
Question.
Yes.
So for finance cost saving, I only calculated using the old overdraft amount and the new overdraft amount.
Oh, you forgot the other.
Well, yes, but I got the same answer, so I was wondering.
Oh, okay. Oh, okay. Oh, okay. That's surprising. It is cost. Okay, it could be a possibility. But now what will be the difference is that these figures will be different, isn't it?
Yes.
Yeah, okay. Okay, it's quite surprising. Okay, fair enough. You may get it. Don't forget, in case this is going to be a question on analysis, then you may get it wrong. However, the answer might be right. In case it's a section A, section B question, no problem. You can still get the same answer. But if it will be a section C type of question, then you may be denied question there at the mark because you did it from a wrong perspective. But why? I'm quite surprised that you do get the same answer, even if you were to only use the overdraft. Okay, okay. Okay, that's good. Any other question? Therefore, should the company implement the proposal? The question: should the company implement this proposal? Is this proposal a good proposal? That's the question.
Yes.
Yes, it is, definitely. Okay, the company should implement this proposal since it yields an annual net saving of that $425. That $4,025. Yes, that's a good proposal. Okay. You can see the how question can be tested. Okay, they can be twisted or easy question. Okay. So anyway, I guess maybe after break we shall come and attempt one more question. Then we move on to the next bit of the syllabus. Okay. If there's no question, then I guess we can meet at 11:15. Okay, see you then. Don't forget to sign.